Okay, let's unpack this. When you look at a company's financial health, that big, shiny profit number on the income statement, well, it seems like the only thing that
It
matters.
does, doesn't it?
But anyone who's ever had cash flow problems, in their own life knows that what you earn on paper isn't always what's actually in your bank account.
Hmm.
So why is a company's stated profit sometimes not the full, truthful story?
Because fundamentally, profit is, well, it's an opinion. It's rooted in accrual accounting, but cash, that's a verifiable fact. Our mission today is to dive deep into International Accounting Standard 7, that's IASS 7, to really understand the Statement of Cash Flows, or the SCF. This document, I think, is often the most important tool for assessing a company's real stability.
Right. And the high-level takeaway for you listening, why bother with this statement when you've already got a profit figure?
Well, the SCF cuts through all those accounting policy choices and the judgments that influence profit figures.
Hmm.
It provides crucial, hard data on liquidity, viability, and financial adaptability information that profit numbers frequently mask. You can't pay suppliers with profit, you pay them with cash. This statement shows exactly where that cash came from and where it went.
Okay, that distinction is key. Profit is opinion, cash is fact. The sources really emphasize that profit figures are, let's say, relatively easy to manipulate or influence.
Mm.
Can you explain where that vulnerability comes from?
The vulnerability comes entirely from management's judgment. Profit relies heavily on estimates. For example, management decides how quickly to depreciate a piece of equipment, right?
Hmm.
Or how much inventory might be worthless next year, or how large the reserve for uncollectible customer debts should be. Because judgment is involved, those figures can be, well, managed to paint a prettier picture sometimes.
So, if the financial world maybe lost a bit of confidence in accrual-based profit because of those subjective judgments, the solution was creating a statement that tracks only the hard currency movement. Is that it?
Exactly. IAS 7's core objective is to classify and disclose the historical changes in cash and cash equivalents. It is difficult to manipulate because, simply put, the money either moved in or moved out. It's factual.
And cash equivalents, what does that cover exactly?
Yeah, good question. By cash, we mean ready money. So cash on hand and demand deposits. By cash equivalents, we mean things like short-term, highly liquid investments that are almost instantly convertible back to cash with no significant risk of value change. Think very short-term money market funds, maybe.
Got it. Now, to make this useful, IAS 7 doesn't just give us one giant number. It mandates separating all cash flow into three distinct categories, or like you said, buckets. Why the separation?
Oh, separating them is absolutely crucial for analysis. It allows the user, you, to see if the company is generating cash from its core business.
Right, the day-to-day stuff.
Exactly. Or if it's having to sell off assets or borrow money just to stay afloat. These buckets are operating activities, investing activities, and financing activities.
Okay, three buckets. Let's start with the first one.
Let's start with operating activities, which is usually where most of the complexity lies. Our source material focuses heavily on the indirect method for calculating this. Now, this can feel a bit counterintuitive at first,
How so?
because we start with the reported operating profit, the number from the income statement, and then we basically reverse engineer it to find the actual cash position.
Ah, okay. It's like starting at the destination, that profit number, and asking, okay, what detours did we take where cash didn't actually follow the income or expense?
That's a perfect way to put it, yeah. And the first, easiest detours to fix are non-cash expenses. Depreciation and amortization are the classic examples here.
Right, because you record them as an expense, lowering profit, but no actual money left the company.
Precisely. These were expenses deducted to calculate profit, but no cash actually left the building. So, since we want to know the cash position, we must simply add them back to the reported profit.
Okay, add back depreciation. Makes
Yeah.
sense. What else needs adjusting?
We also have to neutralize anything that affected operating profit but really belongs in another bucket, like the profit or loss you make from selling off old equipment.
Okay, why is that?
Well, if you sell a piece of machinery, the total cash you receive for it, that goes straight into the investing section later on. So if you recorded a profit on that sale in your operating profit calculation,
It inflated the operating number.
exactly, it artificially inflated your operating profit. Therefore, you must deduct that profit from the operating calculation. It prevents double counting the cash inflow when we get to the investing section. Same logic for a loss, you'd add it back.
Okay, this is all sort of cleaning up the profit number.
Yeah.
But then comes the really insightful part, right? The working capital movement.
Yes. This is where the cash flow narrative can most often flip the story told by the profit and loss statement. This really gets to the heart of day-to-day cash management.
Let's tackle the tricky ones people often stumble over: receivables and inventory.
Okay, so this is where we see whether management is selling promises or actually collecting money. Think about it. If trade receivables increase, what does that mean?
It means sales went up, profit was recorded, but the customers haven't paid yet.
Correct. Cash was not received. So, to reflect that cash shortfall compared to the profit figure, we must deduct the increase in receivables from the operating profit.
So counterintuitively, an increase in an asset line item, like receivables, is actually bad for operating cash flow in this calculation.
Generally, yes, for operating cash flow calculation using the indirect method. Same logic applies to inventory. If you bought more raw materials or finished goods than you used or sold during the period, your inventory level goes up.
And you spent cash buying that extra inventory.
You got it. That cash outflow hasn't yet been reflected as an expense on the income statement. It will be later when the inventory is sold. So for now, we deduct that increase in inventory from profit to show the immediate cash drain.
Okay, increases in receivables and inventory reduce cash flow. What about the other side, liabilities, like trade payables?
Now this works the other way. If trade payables increase, that means we recorded an expense, perhaps for supplies or services we receive.
But we haven't paid the bill yet.
Exactly. We haven't paid the supplier yet. So relative to the expense we already recorded, we've held onto the cash.
So an increase in payables is good for cash flow.
In this calculation, it's an addition back to profit. The company essentially used the supplier as a kind of interest-free, short-term financier. You retain the cash longer, improving your short-term liquidity. This whole working capital section, it really reveals how effectively a company manages its day-to-day cash conversion cycle.
Fascinating. Okay, so that's operating activities. That tells us about the day-to-day running. What do the next two sections reveal?
They tell us about the long-term strategy and funding. Let's move to investing activities.
Okay. If operations is the company's daily income generation, the investing section sounds like it shows us what they're buying to keep that income machine running and growing.
That's exactly right. Investing flows relate to the acquisition and disposal of non-current assets. Think long-term assets intended to generate profit over multiple periods. This is where you see the cash purchases of property, plant, and equipment, or PPE.
Like buying new factories or machinery?
Yes. But also the cash proceeds received from selling those types of assets. And it also includes things like interest received and dividend received on investments the company holds in other entities.
Got it. And the third bucket, financing activities. That sounds like it's about where the money comes from externally.
Precisely. This section tracks changes in the size and mix of the company's equity and debt. It's all about how the company funds itself. So we see cash inflows from things like issuing new shares or taking out long-term borrowings.
And outflows.
Outflows would be things like repaying the principal on loans, making lease payments the principal portion, not the interest, and of course paying dividends to shareholders. These activities fundamentally change the capital structure of the business, the balance between debt and equity.
Okay, so operating is the engine, investing is building and maintaining the engine, and financing is getting the fuel or paying back the fuel providers.
That's a pretty good analogy, actually.
Now, here's where you said it gets really interesting for strategic analysis, comparing the company's investment in new non-current assets, from the investing section to the depreciation charge we saw back in the operating adjustments.
Yes, this is a critical check on, let's call it, capacity maintenance or growth. Depreciation is the amount the company says its existing assets are losing in value each year, right? It's an accounting estimate of wear and tear. So you look at the cash actually spent on new non-current assets, the capital expenditure or CAPEX, if that CAPEX is substantially more than the annual depreciation charge.
It suggests they're not just replacing old stuff, they're adding more, expanding.
Strongly suggests it, yes. It signals the entity is expanding and upgrading its asset base. It's growing the engine, to use your analogy. Investing for the future.
Okay, but what if the investment, the CapEx, is less than depreciation?
That could be a warning sign. It suggests they might be running down their asset base. They're letting the engine rust, perhaps not replacing assets as quickly as they wear out.
And since non-current assets are usually what generate future profit.
Exactly. A shrinking asset base can be a major worry for long-term viability and future profitability. It warrants investigation.
Okay, that comparison alone seems incredibly powerful.
It is. It gives you real insight into management strategy and confidence.
So, stepping back, what are the big advantages of using the statement of cash flows overall?
Well, the primary advantage, as we've discussed, is that it allows users like you to assess the relationship between a company's reported profitability, that opinion, and its actual cash generating ability, the fact.
Hmm.
It gives crucial context to the other financial statements. It helps judge liquidity, viability, adaptability.
It sounds incredibly useful, but I assume it has limitations.
Hmm.
It's not meant to stand alone, right?
Absolutely not. That's a key point. SCFs are historical. They tell you what happened, not necessarily what will happen. Predictions require more analysis. And crucially, they must always be used alongside the statement of profit or loss and the statement of financial position. You need the full set for a complete three-dimensional picture.
Why is that?
Well, otherwise, you only see inflows and outflows without the context of the assets, liabilities, and equity that generated them or were affected by them. You need the balance sheet and income statement to understand the why behind the cash movements.
Makes sense. Now, analysts often use something you mentioned earlier, the operational test. What does that involve? What are they looking for?
The operational test asks a really foundational question. Can the cash generated just from normal trading operations, the core business, consistently cover the mandatory payments the company has to make?
Mandatory payments like interest and dividends.
Exactly. Interest on loans is usually non-negotiable, and while dividends can be cut, companies are very reluctant to do so as it signals problems. So if the operating cash flow is insufficient to cover these, the business might be on shaky ground. It could be forced to continuously borrow more money or sell off valuable assets just to meet its basic obligations. That's not sustainable long term.
Let's bring this to life with those source examples. You mentioned the Hollywood case. Their operating profit was $304,000, but the net cash flow from operations was significantly higher at $424,000. That signals good quality profit, doesn't it?
Absolutely. That's a textbook example of high quality profit. When the cash generation from operations is higher than the accrual profit, it generally means the profit is backed by strong, timely cash collection and maybe favorable working capital management.
Like collecting cash from customers quickly, maybe stretching payments to suppliers a bit.
Precisely. The company is effectively managing its receivables, payables, maybe inventory too.
Yeah.
It suggests the reported profit is solid, backed by actual cash.
Okay, now contrast that with the other example, Valeria Co. They had strong operating cash flow, which is good,
Yes.
but they had a massive negative cash flow from financing activities. Why was that?
That negative financing flow was largely because the dividend they paid out was huge. It represented over 40% of their operating cash flow for the period.
Wow, 40%. That seems high.
It is high. It immediately raises a serious red flag for analysts. It forces you to question the sustainability of that dividend policy.
Are they paying out more than they can really afford to maintain long term?
That's the question. Now, the source mentioned they also did a rights issue, issuing new shares for cash, which might suggest management confidence in future performance. They needed cash.
But still, the sheer size of that dividend payment relative to operating cash demands scrutiny. It could suggest they're potentially raising capital partly just to maintain those shareholder payouts rather than primarily investing it for future growth.
That's the kind of critical thinking the SCF enables.
Okay, this deep dive into IA 7 has really hammered home why we need this statement. It clearly shows us that financial analysis has to start by separating cash flows into those three crucial baskets: operating, investing, and financing. The structure gives us that X-ray vision we need to see past the potentially subjective judgments on the income statement.
Exactly. So what does this all mean for you, the savvy financial user listening in? Remember that a huge positive cash balance sitting in the bank account isn't automatically a sign of brilliant management.
Right. Cash can be idle.
Precisely. If that cash is just sitting there collecting minimal interest, it's not being actively invested to generate future profit, nor is it being returned efficiently to shareholders who might have better uses for it. The true test of long-term viability isn't just the quantity of cash a company generates or holds. It's the quality of its source. Is it coming from sustainable operations? And the intelligence of its deployment. Is it being invested wisely or returned appropriately? When you look at the SCF, really dig into it, you are looking straight into the financial engine of the company. You're deciding if it's running efficiently, if it's growing, or if it might be sputtering out. That's the power of cash flow analysis.